What's going on, guys? Mike here, and it is a very exciting day to start our DIY investing beginners course on the Canadian Biweekly Investor YouTube channel. So if you're new here, welcome. Like I said, this is episode 1, and we're going to be kind of covering the things that I've learned and the things that I think new investors definitely need to be aware of moving forward. And some of the highlights I'll be going over are kind of some prerequisites that you need to consider before even starting to invest. We're also going to be looking over some evidence that shows, maybe how risky or how not risky the stock market actually is long term. We're also going to be going over the dividend and growth kind of terminologies within a stock and equity. And just some extra information that I have to share for this first episode. So I hope you guys are excited, and let's get to it. So the first thing that I want to cover is credit cards. So people might ask, well, why do we want to talk about credit cards? Well, people don't realize, but if you're going to be taking $100 a month and starting investing it, well, over the long term, you're probably going to be getting anywhere between 8 to 10% annual return. Hopefully that's what the past is. Hopefully the future is maybe even better. Hopefully it's not worse. But the difference is, though, is instead of taking $100 and then, for long-term capitalizing on that 8% growth, you could just instantly start saving 21%, let's say, if that's what your annual interest is on your credit card, right? So having debt on a credit card really hinders your ability for financial freedom because you continuously have to be paying on a monthly basis, and 21%, or some of them are as high as 26%. So that's something to consider. Before you start investing, make sure that you can pay off your credit cards. We should have that paid off, and so that we can start, instead of spending 21%, we're going to start gaining a minimum, hopefully, of 8% on an annual basis. So that's number 1. Number 2 is having an emergency fund. Now, everyone's definition of an emergency fund is different, right? Some people say you need 6 months, and some people are like, well, how am I ever going to get 6 months of an emergency fund sitting in a bank account? I can barely pay off my credit card. So when I first started out, I would have to say that, I had the credit cards paid off, and my emergency fund was a line of credit or a credit card, right? I didn't have the amount of money that I could be just having it sit in a bank account. So you need to ask yourself what you feel comfortable with, and figure out what you want to have. Is it a line of credit you want to have as an emergency fund? Or is it something where you want to have a few $1,000s tucked away? Or maybe you want to have a full 2 months of emergency set aside. So if you do go down the path of having a few $1,000s on the side, I highly recommend not leaving this, because this is a mistake I did, leaving it in a bank account that does absolutely nothing for you, okay? So what I would recommend is EQ Bank, which you'll see a video here I have linked, and I also have a description below that has a referral that gets you $20 and also gives me a little bit of commission, so thank you for supporting the channel. But EQ Bank right now currently has an everyday savings account of 2.5%. So if you have $1,000 or maybe $5,000, you might as well move that over to a high interest savings account for your emergency fund, and at least accumulate 2.5%. I think that is an acceptable way, having a little bit of a slush fund just for in case, and it collects 2.5%. So that's number 2. Number 3 is the fun part. That's where we start investing. So what are we going to start investing in? Well, before we do that, we really need to kind of get an idea as to what we're looking at. So before I get started, I really want to touch on the stock market risks. So I'm going to show you a picture here. And it basically is the data from, I think it's 1926 to 2021, and it shows you the probability of losing or gaining in the stock market based on time. So you'll see here, based on a 1-day turnover, so if you bought a stock and then you sold it the next day, you basically have a 50-50 chance of making money or losing money, right? And then if you skim down all the way to the bottom at 20 years, you have a 95% chance of gaining money and a 5% chance of being in the negatives. Now, I also want to point out that this is based off of the US stock market, like the SP 500, as well as, and sorry, the SP 500 is an index, and we will cover that in a future video. Sorry if you don't know what that is yet. but this is based off of like high quality, diversified investment portfolio. In a diversified portfolio, meaning like you don't have all your eggs in one basket, because let's face it, reputable companies do fail. Some of you might remember BlackBerry. They were high on that list, but where are they today? Right? So this is assuming your 95% chance of being positive after 20 years is based on a diversified portfolio. Okay, so we're not putting all our eggs in one basket. So I think this is absolute critical to understand when you start your investing journey, because so many people will, they'll invest and then say after 3 months they're down 5%, and then they sell and they're like, oh, the stock market is just not for me. You need to realize that is going to happen, and you need to tell yourself that this is okay, right? This is a part of the strategy. When it goes down, you need to tell yourself it's like you're buying the stocks or the equities at a discount, right? You go to Walmart, you much rather buy it on sale than you do for full price, right? So look at it that way. If you look at anywhere in the stock market where, like say in reputable companies, there's a dip and then it comes right back, right? So you might as well buy at the lower than say buying at the high, right? So just kind of keep that in mind. Also too, I just kind of want to touch on when it comes to like the fluctuations on a daily basis, a yearly basis, or whichever. One of the metaphors I always kind of think to myself is that, okay, let's just pretend that your house value has dropped $50,000 due to the current environments of this world. Did the house actually change? Did it perform in any way different than when it was $50,000 of value more? Probably not, right? So as an investor, if you are investing into individual stocks, there are other options like ETFs, which we will cover in a future video as what an ETF is. But if you're doing individual stocks, you need to ask yourself, when there is a dip, is there a specific reason as to why she's dipping? Or is it based on just people's feelings and they're scared of the equity market right now because of high interest rates are going up or that kind of thing, right? You need to realize, like, for example, like TD Canada Trust, if you go over their stock price over like all the years they've been in business, it does this, but over time it just keeps going up, right? So you also need to realize, like, say, TD Canada Trust has gone through like World War II. It's gone through the 2008 financial crisis. It's gone through the dot-com crisis. It's gone through the pandemic crisis, right? And they've always survived it. So again, this is assuming you're investing into quality companies. If you're investing into like something that's a startup, then yeah, there's a potential when it dips, it's not coming back. Again, diversification. Maybe you have a small percentage of your portfolio, like 5%, in startups or like emerging markets, or something that's more risky, right? But we'll get into that in the future videos as well. So the next thing I want to talk about is what a stock is, right? So a stock is an ownership of a company. So if you buy one stock of Home Depot, you are technically a part owner of Home Depot. So of course, like when you're looking at Home Depot or TD or TELUS, like there's hundreds of millions of shares, right? So even if you just own one share, like you're at 0.0000% of an actual shareholder. But it's still, you kind of need to make investing fun. So like when I go to my friends, I tell them, oh, I'm an owner at TD. If you have any issues, I can probably get someone to help you with that. So you need to have fun with it, right? But yeah, so that's what it is. Now, sometimes stocks will also be referred to as equities, okay? They're the same thing. When you look at like fact sheets of like, mutual funds or ETFs, they will have like, they're invested into like 40% equities or whatever. That means they're invested into like actual individual stocks. So something that is important to know. Now, when it comes to buying stocks or really anything, there's kind of two categories. One being capital growth and one being dividends or dividends paid. So looking at TELUS, you'll see here like the stock price, ranges anywhere between $26, $27. And they also pay just over a 5% dividend yield. So a dividend yield is the profits of the business being paid out annually to the shareholders. Now, they can be paid out monthly, they can be paid out quarterly, or annually. Depends on the company. Most of them, I think, are probably quarterly, but there are quite a few that are also monthly. So you have to look that over. Now, 5% annual, that means that you're getting your 5%. So if you own a TELUS stock at say $27, that's roughly maybe about $1.40, $1.50 that it'll pay you in your pocket every year, right? Now, one thing that is really important to understand, so we're going to get into capital growth or capital return now, and that is the stock increase of price, right? So if you buy at 27 and then it's now $30, well, that's capital growth, right? So one of the things that I really want to touch on is total return. So many people get so excited that you get a 5% dividend, and you're thinking that, oh, I get 5% for guaranteed for the next year, for the years to come. Well, one, dividends are not guaranteed. Some companies either cut them completely or they will reduce them during hard times. So that's another thing to check into, and we'll get into that in a future video on how to assess companies when you're thinking about purchasing them. But it's always about the total return. If I were to get 5% dividends, but then the stock price drops by 5%, I technically gained nothing, right? So many people get tied up or caught in this dividend trap that they're paying 13% dividends. But yeah, if you look at the stock price though, it's been on a downward trend for 10 years, and eventually they're gonna have to do something because they're gonna have no money, right? So again, it's always about the total return. Don't always just look at the dividend itself, because there's so many other things to consider. And like I said, we'll get into that in later videos. This is just a high level of everything. So always ensure that you don't fall for those traps, right? So it's always about total return. So I personally like the balance, all right? There's some companies that really don't have any capital growth and it's just strictly dividends. But I like kind of having both, the best of both worlds per se, right? So the reason why I like dividends is because it's either I have the choice to reinvest it into that exact same company, or I can take my profits and I can say buy another stock with it, another equity somewhere else. It's like, oh, yes, TELUS is doing really good in the tech world, but I really want to get into REITs, and REITs are real estate investment trust, basically like owning real estate, but without having to be the landlord. Again, we'll get into that in another video. So yeah, you want to take that dividends, and I want to now put it into a REIT, right? Just to kind of, again, diversify your portfolio. So that's something that's really important. Like I said, total return, always need to focus on total return. It's not just about dividends. And technically, like, dividends like pulls away from the capital of the stock, right? Like if it's going to be paying out 5%, well, technically the company has to grow by 5% to just keep that stock price at the same size or the same level, right? So again, if you don't want a company paying you so much dividends that it's just hindering the actual stock price of it, right? So something to always consider. So the next thing I really want to touch on is the types of exchanges. So there's like the TSX, which is the Toronto Stock Exchange. Then you have like the New York Stock Exchange, and you have the NASDAQ, and so on and so forth. So one thing that's really important is, again, in a future video, we will go over kind of like choosing your online broker. So myself, I use Wealthsimple. Again, referral links below. So yeah, like I said, I use Wealthsimple. I will also go over in a future video as to why I personally chose Wealthsimple. But so just as a very high level highlight, like Wealthsimple, you don't pay any commissions or anything when you're buying strictly TSX, right? So the Toronto Stock Exchange. So if I'm just buying Canadian companies, I don't have to pay like, conversion fees, or like some other online brokers like Questrade can charge as much as $5 a transaction, right? So if you're buying a $50 stock and you're only buying one, and you have to pay $5 for that, well, like, you're significantly already in the negatives, because now you need that stock to return another 10% just to reclaim your commission fees back, right? So again, as a bi-weekly investor, I thought it was very important for me to have 0 fee commissions. So again, like I said, we'll cover that in more detail in the future, but the main highlight of this is the difference in exchanges. And like you'll see here, Enbridge, you can buy on the New York Stock Exchange in a US currency, or you can buy it on the TSX, Toronto Stock Exchange, in Canadian, right? So if you're on Wealthsimple, it would make probably more sense to buy it on the Toronto Stock Exchange, right? So again, it's just you need to be aware of these differences. So when you look on Google, you know, for Enbridge, it'll be ENB, you know, and TSX, or sometimes it'll be like .to, right? TO is again Toronto Stock Exchange. So again, we'll get into that in more detail in a future video, but there's the difference of exchanges, and they all offer kind of something a little bit different, right, in regards to what brokers you have, etc. So I hope that this first video was informative. Again, this is episode 1 of the beginner series here of DIY investing. If you guys have any questions, definitely make sure you comment below. Maybe there's something you want me to cover in a future video that you can't find anywhere else get explained. Definitely subscribe if you want to get this future content, and I hope you enjoyed, and I will see you next time.